Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Aux Electric Co. Limited annual report. Aux Electric Co. Limited offers a diverse range of air conditioning solutions under the brand name AUX. Their product portfolio includes wall-mounted air conditioners, vertical cabinet air conditioners, domestic central air conditioning systems, light commercial air conditioners, and commercial air conditioners. In addition to these standard products, Aux Electric Co. Limited also provides commercial heat pumps and custom project cases tailored to specific client needs. The company's products are sold through retail stores, providing customers with a convenient shopping experience. With its extensive product lineup and sales channels, Aux Electric Co. Limited has established itself as a prominent player in the air conditioning industry. As a subsidiary of AUX Holdings Group Co. Limited, the company benefits from the resources and expertise of its parent organization. Aux Electric Co. Limited, market capitalization of $15 billion, is significantly larger than the average industry peer of roughly $0 billion. This shows that Aux Electric Co. Limited holds a significant advantage in their industry. Aux Electric Co. Limited trades at a lower price-to-earnings ratio of 4 times and a higher price-to-book ratio of 1.24 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The company exhibits a very high leverage profile, with liabilities accounting for 84% of total assets. This elevated debt level warrants heightened caution, as it may limit the company financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth for the company can be attributed to several key factors. Firstly, the sale of household air conditioners saw a significant increase of RMB 319 million, contributing to the overall revenue growth. Additionally, government grants and income-related government grants also experienced substantial increases. Domestic sales grew by 0.7%, driven by national subsidy policies and high summer temperatures. The company's online sales share in the price segment below RMB 210 increased by 4.5 percentage points year-on-year, while new e-commerce platforms represented by Douyin achieved remarkable growth of 40% year-over-year. The company also experienced rapid growth rates in Northeast and Northwest China due to extreme weather conditions in July and August 2025. Furthermore, the adoption of energy-saving and low-carbon development, intelligent interaction, comfort and health features, and deepening online retail models contributed to revenue growth. In terms of international expansion, the company launched new products in the Middle East and Europe, established 5 new overseas sales companies, and expanded its after-sales service network to 7 countries and regions. The company's strategic cooperation with AMAP for digital channel network map and precision marketing through data dashboards also drove revenue growth. On the other hand, the primary drivers of revenue decline were mainly related to gross rental income from operating leases, sale of air conditioners, installation services, royalty income, sales of scrap and raw materials, and others category. The Hudson brand experienced a significant decline of 39%, while North America saw a year-over-year decline of 30.7%. The net income of the company decreased by a significant 23.2% over the period under review. This decline was accompanied by a decrease in profit margins across various product categories. The gross profit margin dropped from 21% to 18.8%, indicating a loss of 2.2 percentage points. A closer look at the profit margins for specific products reveals mixed trends. Household air conditioners saw their profit margins shrink by 3.2%, while central air conditioners experienced a marginal increase of 0.6%. On the other hand, others category witnessed a substantial surge in profit margins, rising by 38.1%. The reasons behind this decline in net income and profit margins are multifaceted. Intensified market competition has put pressure on the company's pricing power. Additionally, rising prices of raw materials have increased costs, while high inventory levels in some regions have further eroded profitability. The impact of tariffs and retaliatory trade measures has also been a significant contributor to this decline. The company's financial performance indicates a significant milestone. One of the key indicators of a company's health is its ability to generate positive operating cash flow. This means that the company is able to produce more cash from its core operations than it spends on various activities, such as paying salaries and purchasing raw materials. This achievement suggests that the company has successfully managed its expenses and optimized its revenue streams. As a result, it can invest in growth initiatives, pay off debts, or return value to shareholders through dividends or share buybacks. The generation of positive operating cash flow is a testament to the company's financial discipline and its ability to sustain long-term success. The company's debt level and interest expenses have undergone significant changes in the recent period. In terms of debt level, there has been a notable decrease in non-current liabilities from RMB 82.4 million to RMB 840.9 million. Furthermore, interest-bearing bank borrowings under non-current liabilities have also decreased by RMB 192,647 from RMB 895,493 to RMB 602,846. However, despite the reduction in debt levels, the company's interest expenses have increased significantly. Finance costs rose by 26.5% to RMB 57.1 million, indicating a substantial increase in the company's financial obligations. This suggests that while the company has managed to reduce its debt burden, it is still facing higher interest expenses, which may impact its profitability and cash flow. Management's primary focus is on cultivating and promoting talented individuals within the company. This emphasis on internal development suggests a commitment to nurturing existing skills and expertise, rather than solely relying on external hires. In addition to talent cultivation, management is also actively seeking out new investment opportunities that align with and complement the core business. This strategic approach aims to create synergies between new ventures and established operations, potentially driving growth and expansion while minimizing risks. The company has a history of paying dividends to its shareholders. In the past year, it declared and paid out a significant amount for the 2024 dividend, totaling approximately RMB 3,793,500,000. This demonstrates the company's commitment to returning value to its investors through regular dividend payments. Looking ahead to 2025, the proposed final dividend per share is set at RMB 0.06. If approved, this will be another instance of the company distributing a portion of its profits back to shareholders. The total amount for the 2025 dividend distribution has not been specified, but it is clear that the company intends to continue paying dividends in the future. Concerns about inventory buildup and supply chain disruption are evident in the recent market trends. One major concern is the accumulation of inventory, particularly with the sale of household air conditioners, which has led to a significant backlog in channel inventory. This issue is further exacerbated by high inventory levels in certain regions. Furthermore, there are also concerns about supply chain disruptions. The decrease in finished goods in transit by 44.5% indicates a potential bottleneck in the supply chain. Additionally, the risk of raw material price fluctuations and supply shortages poses another challenge to businesses. The continued disruptions from overseas tariff policies have also contributed to these issues. These concerns highlight the need for companies to reassess their inventory management strategies and supply chain operations to mitigate these risks and ensure business continuity. That concludes the financial summary for Aux Electric Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.